I think it's important though for any business owner to understand what the balance sheet means. I do think that a lot of people would receive it from their accountant, sign it and go, okay, but not necessarily understand it.
Yeah, I think so. I think the more you use a balance sheet and a set of accounts, the more you get used to it. So this is where sitting down and looking at a balance sheet, maybe on a monthly or a quarterly basis, rather than just once a year. Welcome to the Ledger Lounge. This week I'm joined by Katie.
Hi.
Nearly forgot your name then. And Lauren.
Hello.
Today we're going to follow on from last time's demystifying the profit and loss with the other major financial statement, the balance sheet, or as it's called these days, the statement of assets. The new FRS term is for it, which I think actually probably is a bit easier for people to understand.
I like balance sheet.
Do you?
Yeah,
I suppose
I like it.
tells you it balances.
Yeah.
Hopefully it balances.
Yeah, hopefully.
Yeah. Hopefully the top of it and the bottom of it agree.
Yeah.
But, I think financial statements tend to be just a list of numbers to some people.
Anybody with a limited company, they'll get a set of accounts and they'll have the profit and loss and the balance sheet, and they might look at it and go, okay, but what does it mean?
Yeah.
They might not understand it. So hopefully we can drill down into some of the terminology so that it makes sense.
I always think a balance sheet is a bit like a photograph of your business at a particular point in time. Doesn't necessarily have to be a year end. It can be a month end, a quarter end. It can be at any time, any day.
Yeah.
Whereas a profit and loss account shows you something that happened between two periods. It's like a snapshot of what you own, what it owes, and I suppose then what it's worth, but not as in value terms, as in net asset terms.
So, balance sheet, what's on it? What would people be looking like? What are we looking for on the balance sheet? Assets, liabilities?
That's where it starts.
Yeah.
That's it.
Yeah.
And then I guess at the top, fixed assets,
Yeah.
or the new term is non-current asset. I think that's probably the only new term I'm not as comfortable with
Asset.
as fixed assets, and that'd be assets are things you own,
Yeah.
liabilities are things that you owe. So
So your plant, your vehicles, all them kind of
Yeah.
things.
It's going to be within your business for longer than 12 months.
Yeah.
Yeah.
So, yeah, all your vehicles and anything else that like a deposit held that you're going to be holding for a number of years or something like that.
and what we do with those, so you're going to keep an asset for 5 years. We depreciate it, so write it off over 5 years. Doesn't mean, again, it's not an indication of what it's worth. It's just an indication of that's what I've used of that asset in a period. So it's not necessarily.
It's like a lifespan thing, isn't it? So if it's a vehicle and it'll be depreciated over X number of years, that's the lifespan of that vehicle.
And I think I don't know, it's just us as accountants, we just automatically go, right, cars over 4 years, plant over
They
5
tend to
years.
end up replacing them, don't they? Most people, anyway, after 4 to 5 years.
But it doesn't really matter, does it?
No.
Because you might decide I'm going to keep that van for 10 years and depreciate it over 10 years. And actually there's something to be said for doing that, because if you do that, it's going to keep more value on your balance sheet and you get the assets higher for longer.
Yeah. We've got property. That would be on your fixed assets, and we usually actually in real life would appreciate in value and not depreciate it. So that's a tricky one, really.
But you do have to depreciate it.
Yeah.
If you're a company anyway. Rules say you have to.
Although in real life, generally, they're not going to go down, are they? Hopefully. Unless it's in disrepair.
Unless it's on King Street in Oldham.
Yeah, and it's collapsed. Oops.
So then the next bit, I always think that a balance sheet as well it runs in order of liquidity. So the top is the most illiquid or the hardest bit to turn into cash. So at the top of your balance sheet, you've got fixed assets. So it's always going to take longer, or it's going to be more difficult to turn those into cash. Then you've got your current assets. So they're the ones that you think, I'm going to dispose of them in the next 12 months. So in less than 12 months. So within that, you've got, and again, I think in order of liquidity. So you've got your stock, and then you've got your debtors generally, and then you've got your cash. So your stock is further away from being cash than debtors, which is further away than being cash than cash, because it is cash.
Cash is cash, yeah. So the terminology for current assets has not really changed that much, has it?
No,
It,
No, I
it
think-
pretty much is what it says on the tin, isn't it?
Yeah.
Yeah, I think that's where the fixed assets has come in as non-current assets, just to distinguish it. They obviously couldn't
Yeah.
think of anything more appropriate for current assets.
Stock.
So I guess your stock is you bought something, but at the time you are drawing up your balance sheet, you've not sold it yet.
Yeah.
So you've still got it in hand. So in effect, what you're saying is, that's the bit that I still that I've paid for, that I haven't used yet, and I'm carrying it forward to a period in the future when I'm going to pay for it.
So when we ask for stock, it's because we're taking that cost out of the P&L and putting it on the balance sheet, because that is an asset of your business. You've got this amount of stock left at that point in time, whether it's your year end or, like Matthew said, at any point in time that you're producing a balance sheet.
And we can go into some really nerdy valuation methods of stock.
Yeah.
Thinking back to your
Or
your studying.
non-nerdy for some people who just open the room that they keep it in and go, yeah, about.
Or the people
That'll do.
Yeah.
that say it's the same every year.
Yeah.
About £1,000.
Yeah.
But the principle is you value it at cost or what you can sell it for. So if what you can sell it for is less, so it might be obsolete. So you might think, I'm going to scrap that, or I just get shuts of it in a job lot.
We had a client once that had carried a lot of stock, but it was worth nothing, and we used to say, just get rid of it, sell it, try and sell it at least. Like you're rolling
We
it
did.
forward.
I
You're
think
doing a stock take on items that you're never going to sell really, or it's not worth what.
we did have a long-term
I don't know whether
client.
they were discontinued or something, or people just weren't interested in buying.
It was like a electrical shop, and they sold stuff for electricians, but occasionally get these random, like a snow globe or a snowman or something.
Yeah, and there
And
were
I
quite
thought,
a lot of stuff that they held that was under these all different regulations, didn't there, with like electricians. I can't remember what the word is, but
edition.
that's it, like 17.
I
should know
you
that,
should
but
know that. You worked
they
in
were like
electricians.
17th edition stuff that was
Yes.
obsolete. Like nobody, if you used it, then you wouldn't pass your electrical survey when you sold your house anyway.
Right.
And they kept hold of it. We must just get rid of it.
Yeah. Yeah.
Literally scrap it.
Yeah.
Yeah, I remember once going, and I think this snow globe or this snowman was in the window of the shop for about 10 years running. And it was just gathering dust, and they kept valuing it at the same value. And
Yeah, we used to have to go on a weekend, didn't we, to
we did.
do the stock
Yeah,
take with
we did. The good old days of auditing.
Yeah. Yeah.
Thankfully, we don't have to do that anymore.
I was
think-
pregnant once when I went, and they was like, yeah, all the stock's in that loft up there. I was like, I'm not going up there.
Yeah, I think the same can be said as well if sometimes people make bad decisions where they buy.
At the time, it's probably a
number-
good decision
yeah.
for them, but
They think, well, I'm getting a really good deal on this pallet of whatever it may be, but then it doesn't work out and can value that at less because nobody wants them.
Yeah, I think we had a client who did that as well, bought a container load of baby strollers from when the wheels fell off or something like that, the first push. Yeah, he was stuck with them because I don't think he could send them back to China.
Oh,
So, yeah, that wasn't a great deal. So I don't think we revalued those at anything
yeah.
in the stock.
Write them off.
So the next one down the list, debtors.
now trade receivables.
It's confusing terminology that I think.
it is. Yeah,
Trade receivables.
No, debtors.
Debtors.
I think it is. I think if you think of yourself as a debtor, you think you owe somebody some money.
Yeah.
So it's like the wrong way round.
Yeah.
But actually, debtors in a set of accounts means that you're owed money.
Yeah.
And I do think that trade receivables or account receivables gives
Understandable.
way more clarity to
Yeah.
what you're looking at.
Yeah, because debtors contains the word debt.
Debt.
So people
Yeah.
automatically think,
Well, I don't owe that
I
much
owe
money.
that. But it's actually what the company is owed.
Yeah, yeah.
So, yeah, that can be a little bit confusing. But yeah, trade receivables, it's receivables of money owed into the company. So that makes more sense, I think. So, yeah, that's pretty much what your company is owed from the trade that it makes at that point in time. So you've made a sale for £1,000, but that person's not paid you as of the snapshot date, whether that's your year end or whatever else. So that's what will be included in there.
Yeah, that's right. Yeah. And you can, if you think somebody's not going to pay you, we can put a provision against that. So we call that a bad debt provision. You see, we've never changed the name of that, have we? To a bad
receivables.
account receivables provision.
Yeah, so that's
doesn't
super
flow quite the
confusing.
same, does it?
And then once that provision's in there, if it's still unpaid after 6 months, we can actually write that off then.
Yeah, claim the VAT back.
Yeah.
Yep. And then I suppose following down then, the last element is banking cash. Now, I'm not sure you can
I don't think they're going to change
explain
that
what
one.
that's going to be or change the name of it.
No.
But that'd be the cash that you've got in hand. So you're overdrawn on your balance sheet. It wouldn't show there because it'd be on the liabilities side. So if you had bank loans or you had an overdraft, that'd be on the other side.
So if your year end was 31st of March and your obviously your balance sheet is at that date, it's what amount of money you had in the bank on the 31st of March and what you held in cash on the 31st of March. Yeah, there's nothing more really to explain on that. It's what you've got at that point in time, isn't it?
Yeah, it is. All of that goes towards a thing called working capital. It's not a balance sheet term, it's just a business term. And that's the money that you've got at your disposal to run your business. So your stock, your inventory, your account receivables and your cash all go towards working capital. And that is a good measure. So having a good working capital, level of working capital, gives you the confidence in your business that it's doing well because you're able to pay your debts and run your business.
So we've got creditors, amounts falling due within 1 year.
So that
Next
is,
on the
as it
balance
says on
sheet.
the tin, I think,
Yeah,
Current liabilities.
yeah.
anything that I'm going to have to pay out
Within the
to people I owe
year.
money to in the next 12 months. The example of that are,
Trade creditors, now known as trade payables. Who am I paying?
what does Zero call it? Account payable, isn't
Age
it?
payable.
Accounts
age
Account
payables.
payables, yeah.
Other examples, VAT owed. And
Yeah,
loans
that's
due
always going to be
within 1
payable
year.
in 12 months, isn't it?
Yeah.
Yeah.
Or should be.
Yeah.
yeah.
And if you've got a loan, so a lot of people took
Bounce
back loans, didn't they, in COVID? And I think we're now seeing, it was a loan over 5 years, but you had a year before you had to start paying it.
Yeah.
So we're now 6 years on, and the first ones are now starting to get
Yeah.
repaid
I think-
completely.
What falls into there as well is HP payments, like due within a year as
Yeah.
well.
Yeah. Yes.
So it's pretty much everything that the business is going to need to pay within the next 12 months.
Yeah.
And I think jumping back to trade creditors, now trade payables or accounts payables, whatever you want to call it. So if you owe your suppliers anything, the people that you buy goods from, anything to do with the trade of your business, that's what you owe them. And they're always more than likely going to be paid within 12 months because people are on 30-day, 60-day, 90-day payment terms.
Yeah. Yeah. So HP is, if you buy an asset, a non-current asset, which is sat at the top of your balance sheet,
Yeah.
you might have borrowed money to do it.
I think a lot of people do that now. I don't think that it's a common thing to buy a big asset outright unless you've got tons and tons and tons of money because it improves cash flow to spread it.
I always think if you've got cash on your balance sheet, what can I do with that cash? Can I make more money from the cash I've got than the interest that I'd pay on a loan?
Yeah.
Yeah.
I think the answer's probably yes.
You'd hope so, wouldn't you?
Yeah, because especially with a lot of our clients, we're working with a lot of small businesses. And if they're buying a piece of plant and machinery or a van or whatever for 25 grand, spreading those payments over 5 years makes sense.
Yeah.
They know what they've got to pay. It's not a huge upfront cost and they can plough that money into buying more stock or investing in more staff to grow the business.
All of those add up to current liabilities,
Yeah.
which we've got to repay in 12 months. And this is, I always think the next element of the balance sheet is net current assets. And that's the bit that I always think is of the most use because that's a measure of liquidity of how easy it's going to be for you to pay your creditors. So the excess of your current assets over your current liabilities is called your net current assets. And I think there's a ratio for that as well. So the higher the gap, the more excess you've got, which makes it easier to pay.
So you always want your liabilities to be much less than your assets. And that puts your business in a better position.
The other side is if that's a minus.
Don't they get a bad credit rating now if it's in negative? So we've had it recently, haven't we, where we've had to get some accounts done quite quickly after the year end because the balance sheet the prior year didn't look as good. But now it does.
Yeah, and that's the
Develop,
benefit
yeah.
of sort of the way we work as
Yeah,
well
yeah.
in the office, that we've got the ability to do that, and we can get a set of accounts turned around within a couple of weeks
Yeah,
after
yeah.
the year end and get them filed and
Yeah.
help a business improve its
Yeah,
credit rating.
rating.
Yeah,
Yeah,
I think
definitely.
you're right. I think that was a business that had seen a big drop in its net assets
Yeah.
last year, but they had a really good year again. So
Yeah.
you could see that things were going to improve, and they were missing out on tenders because of it.
Mm.
So yeah, one of the balance sheet, the bit we're talking about today, is one of the things that small limited companies file at Companies House. So it's often the only bit on the public record.
Yeah.
And I think you identifying that a couple of weeks after the year end, if they have got a negative balance sheet, you can start talking about, right, that's going to carry over into the next year. What can we do to change
Yeah.
it, to get it to swing the other way?
If you do management accounts, you can monitor that on a monthly basis, and you can look at how that gap is increasing or decreasing, and if it's decreasing, maybe do something about it. And the sooner you can do something about that, the better.
Yeah, definitely.
So then we're getting down to a figure that we call the total assets less current liabilities. So this is then adding into your net current assets, adds in your fixed assets or your non-current assets.
Let's just keep calling them fixed.
Fixed, yeah, should we go with fixed? Yeah. We're getting bored of that now.
Yeah.
Getting bored of new
I'm
terminology.
sticking to my guns.
Yeah, the new word.
I'm not changing.
Yeah. And so that's, again, less of a measure, I think. But if at the point you drew the balance sheet up, you sold your fixed assets for what they're on the balance sheet at, collected all your debtors, sold all your stock for what it's worth on the balance sheet, and paid all your creditors off, you'd end up with a figure. And that would be this figure of total assets less current liabilities.
Yeah. It's almost like the company version of a person's net worth.
The last bit on the balance sheet, after taking account of the total assets less current liabilities, is the liabilities that you owe that you're going to pay in more than 12 months. So what you're looking at there is how much am I owing in the longer term? So I don't need to directly think about it today, but it's something that we need to be aware of for the future. So then it's giving a bit of an overall financial position, I think. So you've got in there, if you've got a 5-year loan, you've got that loan payments that, not year one, but years 2, 3, 4, and 5.
And the same with your
Mortgages.
HP as well.
Yeah, and mortgages. If you
Mortgages.
own your building, or
Yes,
if you're lucky enough to own your building, most people rent, don't they? But
yes, it is. Yeah. Finding a building to buy, I think, is the
Yeah.
difficult bit. Never mind affording it.
I mean, they used to call them long-term creditors, but now they call them, the new terminology is non-current liabilities, isn't it? Which
Yes.
actually I think is nicer because it's very self-explanatory, isn't it? It's a
Yeah.
non-current liability, so it's something you owe 12 months after your accounting year end or
Yeah.
whatever the date is that you're using.
Yeah, so you don't want to ignore them. You just need to be aware of them, I think.
And if you've got sort of something within your non-current liabilities that's like a 5-year loan, then each year that passes by, obviously that'll reduce and it'll move up into your current liabilities.
And then if you got this far with us, without falling
we've not
asleep,
owed you.
then we're down to a figure which is called net assets. So that's total assets less your non-current liabilities,
Or as Lauren said before, the net worth of the company.
the net worth of the company. Yes.
So they used to call that the capital account,
Yeah, that's right. Capital and reserves.
now equity.
That's true, yes.
Which
That's
I
what
don't know which either of those is the better one, because I think they're both quite.
Equity to me feels a bit stock markety
Yeah.
term. It doesn't feel very user-friendly for a small business,
No,
but neither does capital account.
exactly, yeah.
So I don't know,
So we're
maybe
going to have to come up with a new
Like
name for
company
it.
worth.
yeah, net worth.
Yeah, company worth.
Yeah.
Net worth, yeah.
So all these old terms that we do see them in practice. Still quite a lot.
Yeah.
So you might look on a set of accounts on Companies House, you might see the new terminology or the old terminology. They're all they're equally as valid to use. Maybe the new ones explain things a bit better overall. Maybe not in every case, but overall.
I think it's important though for any business owner to understand what the balance sheet means. 'Cause I do think that a lot of people would receive it from their accountant, sign it and go, okay, but not necessarily understand it.
Yeah, I think so. I think the more you use a balance sheet and a set of accounts, the more you get used to it. So this is where sitting down and looking at a balance sheet, maybe on a monthly or a quarterly basis, rather than just once a year.
I do think because we sit down with the majority of our clients when we go through the accounts, and it's usually within 4 months of the year end, we've got more time to explain things to them rather than going, we've done them now. This is your tax or this is not your tax.
Yeah. Yeah, it is a benefit of doing it the way that we do. And I think it's people understanding when they look at the balance sheet. Some people might look at a negative balance sheet and just not even know what that means.
Yes.
And they might not know that actually they want it to be positive.
Yeah.
So,
I saw a balance sheet that was completely skewed the other day, and the reserves figure, the retained earnings figure, was negative, but they'd shown it in a way that added that to creditors. They'd done it almost like...
That sounds like a tagging issue or something.
I got the impression it was more of a, we don't want to highlight the fact that this is an insolvent balance sheet.
Oh. Oops.
And, a little bit of a smoke screen. So on the face of it, you thought, oh, it's doing all right, that. Well, when you actually... If you understood it, and if you listen to this episode now and you understand the structure of a balance sheet, that your net assets is your non-current assets plus your current assets less your current liabilities less your non-current liabilities, that's not how this balance sheet was shown.
Right.
Okay. And so it made the balance sheet, instead of being, I'm going to say £200,000 negative, it was £400,000 positive.
Oops.
So yes, you'd have.
That's a big whoops.
But I think this is where understanding the balance sheet, you'd spot it. And
yeah, definitely.
If we can highlight that, and if you're listening to this and it's made it a bit clearer, then that wouldn't be a bad thing.
Yeah, definitely not. And I think if your accountant doesn't show you or explain your figures in your balance sheet, come and see us.
Absolutely, yes, yeah.
So, what would be if you could do some sort of really quick points to our listeners? Some things to look out for on your balance sheet, some quick tips.
Understanding the order of your balance sheet helps you understand the story of your business. I think we spoke about this on the last episode as well, on the profit and loss. That's what's gone on in the year, and the balance sheet is the rest of the story.
The snapshot, yeah. For me, a big takeaway would be, do I know what the difference between my current assets and my current liabilities are? That's a really important one, because in the next 12 months, am I going to be able to pay with what I've got?
Yeah.
Am I going to be able to pay my liabilities?
Yeah, that's a good one.
That's probably the one that makes you sleep at night.
Yeah, definitely. I mean, it's something that all small business owners should be aware of, really.
Yeah.
We know there's a lot to take in after today's episode. If you're confused or don't really know what we've just been talking about and thought it was a load of jargon, then please speak to your accountant or spepe to us.
Yeah,
excellent.
I think that's good advice.
Really good advice, Peter. So thanks very much for listening.
Thanks, everybody.
We'll see you next time.
I hope you're all looking at your accounts, hoping it balances.
The Ledger Lounge is brought to you by James Scott Accountants in Oldham, Greater Manchester. Please like, rate and subscribe wherever you listen to the show. To find out how James Scott can help you build a better business, visit jamesscott.com. This podcast is a QPod production. Visit kupod.co.uk for more information.